Overnight, 10 million Apple Card holders lost their bank. Goldman Sachs is out. JPMorgan is in. Billions in credit lines, rewards, and personal data just shifted hands. Without a single customer's consent, the world's most valuable tech brand no longer controls your financial experience. Now the rules change. Imagine waking up to find your Apple Card declined at checkout, your payment history in limbo, and no clear answer about who's responsible. Who decides what happens to your money? This isn't just a new logo on your statement. It's a forced migration of trust, risk, and control. Apple promised simplicity and privacy. Goldman Sachs promised stability. Both are gone. JPMorgan inherits a system built for someone else's incentives. The terms you agreed to, they're up for renegotiation. Your credit limit, your rewards, even your data, suddenly subject to a new set of priorities. No one asked if you were ready, but the stakes are immediate. Your next payment could be delayed, your credit score could shift, and your personal data could be evaluated under new standards. The Apple Card was marketed as a seamless extension of Apple's ecosystem, a product that would never sell your data or surprise you with hidden fees. Now, the institution behind those promises has changed. JP Morgan's priorities are not Apple's. The risk profile of every customer is being recalculated. The privacy standards are being re-examined. The entire foundation of trust built on Apple's brand and Goldman's compliance is now in flux. The customer is left exposed with no say in the transition. Apple Card was never a bank account. It was a partnership. Apple designed the interface. Goldman Sachs held the debt, managed the risk, and handled compliance. For Apple, the card was a loyalty engine, a way to lock customers deeper into its ecosystem and collect transaction data without appearing to be a bank. For Goldman, it was a bet on consumer banking, a sector it had largely avoided for over a century. The hope was that Apple's brand would attract high-quality borrowers and low default rates, but the economics never worked. Losses mounted as Apple insisted on customer-friendly features, no fees, instant cashback, generous credit limits. Goldman's risk models, built for traditional banking, couldn't keep up. Apple demanded more features, more flexibility, more customer satisfaction. Goldman wanted out. JP Morgan, already Apple's main corporate banker, stepped in. But this isn't a simple handoff. It's a collision of incompatible systems. Apple's tech-first approach, Goldman's risk aversion, and now JP Morgan's scale-driven banking infrastructure. The core failure, misaligned incentives. Apple wanted seamless user experience and privacy. Goldman needed profit and regulatory safety. Every transaction, every reward, every late fee, each side saw a different value. Apple's insistence on transparency and customer satisfaction meant lower revenues from fees and penalties. Goldman's need for profitability meant tighter credit standards and more aggressive risk controls. The contract locked both parties into obligations neither could sustain. When the numbers stopped adding up, the partnership collapsed. It's like building a house where one partner wants open windows and the other wants a fortress. Eventually, the structure can't hold. Or ask yourself, what happens when the company promising you privacy doesn't actually control your data anymore? JP Morgan inherits not just the accounts, but the unresolved tension between tech's promises and banking's realities. The infrastructure Goldman built was tailored to Apple's demands, not JP Morgan's. The data flows, the risk models, the compliance checks, all were custom fit for a partnership that no longer exists. Now JP Morgan must absorb these accounts, reprice the risk, and decide which promises to keep and which to quietly abandon. The mechanism that made the Apple Card possible, outsourcing risk to a partner with different incentives, has now become the source of instability. The inflection point came when Goldman realized the losses weren't temporary. Apple's demands for customer-friendly features, instant rewards, no fees, aggressive credit limits, clashed with the bank's risk models. Goldman tried to renegotiate. Apple refused. The exit was abrupt. JP Morgan, with deeper pockets and more experience in consumer credit, agreed to take over. But the infrastructure was never built for them. Now JP Morgan must retrofit its own systems onto a product designed for someone else's rules. Every customer is a test case. The transition is not seamless. JP Morgan must decide how much of Apple's original vision to preserve. Do they maintain the same privacy standards? Do they honor the same reward structure? Or do they gradually shift the terms, optimizing for their own bottom line? Each decision risks alienating customers, triggering regulatory scrutiny, or exposing hidden weaknesses in the system. The moment Goldman walked away, the illusion of stability vanished. Now, every Apple card holder is subject to a new set of calculations, ones they never agreed to. This isn't just about Apple Card, it's about what happens when tech companies try to rewrite banking without owning the risk. The illusion of control breaks down when incentives diverge. Customers discover that their loyalty is portable, but their data and debt are not. The new bank can change terms, alter rewards, or tighten credit without input from Apple or its users. The lesson: when financial products are built on partnerships, the real power belongs to whoever holds the risk. The Apple Goldman experiment was supposed to be a blueprint for the future of finance, tech companies designing the experience, banks managing the risk. But when the economics failed, the partnership unraveled. JPMorgan's takeover exposes the fragility of these arrangements. It shows how quickly customer promises can be rewritten, how easily control can shift, and how little recourse consumers have when the institutions behind their money change hands. The Apple Card promised a new era of consumer finance, transparent, user-friendly, and private, but the foundation was always fragile. Now, as JPMorgan rewrites the rules, customers face a new reality. The brand you trust is not the institution that controls your money. In the end, the only certainty is that power in finance remains with those willing to absorb the risk and change the rules when it suits them. Capital rifts, where money breaks,